As I'm recording this on Monday, March 25th, gold futures are down another 6% in overnight trading. That puts the price at roughly $4,286 an ounce. And if you're watching this thinking that sounds low compared to where we were just a few weeks ago, you're right. Gold has now fallen more than 21% from its all-time high, near $5,600. That is the sharpest decline since the 2013 crash. And what's happening right now in the gold market is telling you something much bigger about the global financial system than most people realize. Welcome to my channel. I am Bogdan Macro. This is the place where we track the money, follow the macro, and try to make sense of what's actually happening behind the headlines. If you find this useful, hit subscribe and like the video because that's literally how the algorithm works and it helps other people see this. So let's start with what triggered this. On February 28, the United States and Israel launched joint military strikes on Iran, which included the killing of Iran's supreme leader, Ali Khamenei. Iran responded with retaliatory missile and drone attacks on US military bases, Israeli territory, and other Gulf states. The Islamic Revolutionary Guard Corps then issued warnings prohibiting vessel passage through the Strait of Hormuz. According to Wikipedia's tracking of the crisis, tanker traffic through the strait dropped by approximately 70%, with over 150 ships anchoring outside the strait to avoid the risk. And as of March 12, Iran had reportedly made 21 confirmed attacks on merchant ships. Let me translate that for you. The Strait of Hormuz handles roughly 20 million barrels of oil per day. That is about 20% of global seaborne oil trade. When you effectively shut that down, you don't get a disruption, you get a catastrophe. Brent crude blew past $100 a barrel on March 8 for the first time in 4 years, and spiked as high as $126 at its peak. WTI is currently sitting around $99. According to the Dallas Fed's own research published this month, this closure is expected to raise the average WTI price to $98 a barrel and shave nearly 3 percentage points of global GDP growth in the second quarter. That is enormous. Now, here's where gold comes in. Normally, a hot war in the Middle East with a massive oil supply shock would send money flooding into gold. That's the safe haven trade that everybody knows. But that is not what happened. Gold initially spiked from around $52.96 to $54.23 on the Hormuz news, according to reports. And then it reversed hard, down more than 6% from the intraday high, and it has not stopped falling since. Greg Shearer, who is the head of base and precious metal strategy at JP Morgan, described this on a podcast last Friday as, and I quote, an extremely brutal flush. He said that from JP Morgan's perspective, what it's telling them is more about gold getting caught up in a contagion risk of a sell everything trade. Let me translate that. When the whole financial system comes under stress at the same time, gold doesn't act like a safe haven. It acts like a source of cash. Institutions that are getting margin called on other positions sell gold because gold is liquid. They can get out fast. And that creates a self-reinforcing downward spiral. The second piece of this puzzle is the dollar. The US dollar index pushed above 100 in recent sessions, and when the dollar strengthens, gold gets more expensive for every non-dollar buyer on the planet. Demand drops mechanically. According to ING commodities strategist Eva Monday, writing last Friday, a stronger US dollar and gold's high liquidity can make it a source of funds during stress episodes. That is exactly what is playing out right now. Third development, and this is the one that I think matters the most. The Federal Reserve met on March 18th and delivered what the market is calling a hawkish hold. They kept the federal funds rate at 3.5 to 3.75%, which was expected. But the updated dot plot now projects only 125 basis point cut for the rest of 2026. 7 out of 19 FOMC participants signaled they expect rates to stay completely unchanged this year. That is one more than in December. Chair Powell said during the press conference that it is, quote, too soon to know, end quote, the impact of the war on the economy, but he acknowledged that near-term measures of inflation expectations have risen, likely reflecting the substantial rise in oil prices. The market heard that loud and clear. The 10-year Treasury yield climbed, the S&P fell to session lows, and gold accelerated its decline. Now, separately, across the Atlantic, something arguably even more dramatic is happening. According to Bloomberg, ECB policymakers would be ready to raise interest rates as soon as their April 29th meeting if inflation data deteriorates further. Bundesbank President Joachim Nagel told Bloomberg that a more restrictive monetary policy stance would probably be necessary if inflation expectations rise on a sustained basis. According to LSEG data, traders are now pricing in about 72 basis points worth of ECB hikes in 2026. Barclays and JP Morgan are calling for 3 rate hikes this year. JP Morgan specifically expects April, June, and July. That is a complete reversal from the beginning of the year, when the consensus was that European rates would stay on hold. Now, separately, these are all interesting developments. A war, an oil shock, a hawkish Fed, a potentially hiking ECB, but together, they tell you exactly what is crushing gold right now. Gold pays no interest. It generates no yield. When the entire global central banking apparatus is either holding rates higher for longer or actively discussing hiking, the opportunity cost of holding gold goes up dramatically. Bond yields are rising. Real yields are rising, the dollar is rising, and leveraged traders who rode gold from 2,600 to over 5,500 in 12 months are getting forced out of their positions. According to CNBC reporting, the sell-off in gold and silver has been accompanied by broader risk-off sentiment, with global equities and government bonds falling in tandem. Mining stocks got hammered. The ProShares Ultra Silver ETF dropped 20% in pre-market on Thursday. Silver futures suffered their biggest single-day blow since the 1980s at the end of January and have continued falling. The iShares Silver Trust ETF fell over 4%. As one CIO at British wealth management firm NetWealth put it, financial rather than fundamental investors are the marginal buyers of gold, and they are reducing risk across the board. This is especially true for fast-moving leveraged funds, which are faced with higher borrowing costs. Now here is where I want to be careful, because there are two very different timeframes at play. In the near term, the pressure on gold is real. A stronger dollar, rising yields, margin calls, and evaporating rate cut expectations are all pointing in the same direction. If the dollar index continues to strengthen, some analysts see gold testing 4,400 or even lower. However, and this is important, the longer-term structural picture has not changed. Central banks were net buyers of 230 tons of gold in the fourth quarter of 2025 alone, according to the World Gold Council. JP Morgan is maintaining their year-end 2026 target of $6,300 per ounce. Deutsche Bank is standing behind 6,000. Neither bank has pulled those targets despite the recent correction. Both reportedly see this as a tactical event inside a structural bull market. JP Morgan's own analysts wrote last week that the longer the energy disruption goes on and the more sizable the inflationary and growth impacts become, they still think the backdrop for gold will likely flip materially bullish. Their argument is that economic deterioration would amplify a sharp shift towards Fed easing, as the employment side of the Fed's dual mandate takes precedence. In other words, if this oil shock tips the economy into something worse, the Fed will eventually be forced to cut, and when they do, gold runs again. So let me frame what to watch from here. The first condition is the war itself. According to Axios reporting from just hours ago, Trump said Friday he is considering winding down the war with Iran, and he gave Iran a 48-hour ultimatum on Saturday night to reopen the Strait of Hormuz or face the destruction of its power plants. Meanwhile, a coalition of 22 countries is reportedly working on a UK-led initiative to secure the waterway. If the strait reopens, oil drops, inflation expectations drop, rate hike probabilities drop, and the pressure on gold eases significantly. The second condition is inflation data. The Fed is watching closely. The next PCE print, which was supposed to come March 27th, has been rescheduled to April 9th. So the Fed and markets will be leaning more heavily on CPI, PPI, and jobs data in the near term. The third condition is whether central banks actually follow through on the hawkish rhetoric. Markets are pricing in 72 basis points of ECB hikes. If even half of that materializes, we are in a very different interest rate environment than anyone expected 3 months ago. I am not telling you where gold is going to be next week or next month. Nobody can tell you that honestly. What I am telling you is that the forces acting on gold right now are the most extreme we've seen in decades. A 21% drawdown from all-time highs in less than a month. The worst weekly performance since 1983. An active war disrupting 20% of global oil supply. Central banks on both sides of the Atlantic either holding rates or actively discussing hikes. And leveraged traders getting flushed out of positions they built during a 12-month 65% rally. Draw your own conclusions. Here's my question for the comments. Do you think the Strait of Hormuz will be open or closed by April 30th? And how does your answer change your view on where gold goes from here? Drop that below. If you found this breakdown useful, send it to one person who you think needs to see it. Subscribe if you haven't already. This is Bogdan Macro. I'll see you in the next one. Oh, and before you go, YouTube thinks you might enjoy this video next, so let me know if they're right.